Hello everyone, in this video I want to walk you through my investing strategy, investing in quality companies, and I want to explain the whole process because I believe this is a strategy that can allow you to compound your wealth in the long term and to beat the market. And I've been doing this for almost a decade and I want to share everything with you on this YouTube channel. So in this video we will go through these slides from Tema Durable Quality ETF, and these are very good slides. I recommend you check their websites, and they have a couple of elements what we are looking for, investing in quality companies, resiliency, business models, so that you can find great businesses with a moat that will beat the market. This is your goal after all. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in moaty businesses, wide moat businesses, high quality businesses, and I plan to continue. This is what I do every day, and the goal with this YouTube channel is to help you do the same so you can become a better investor. So why don't we start with some slides from this fund, okay? If you look at the ticker symbol from this fund, it's called TOLL, which is a great ticker symbol to have. You want to be invested in toll road companies, toll gates. Okay, so what is this fund that is quality that nobody knows? You have very few videos on YouTube about this fund. So what do? Why is it special? And why it's a source of inspiration for us quality investor? TOLL seeks to invest in quality companies defined by high barriers to entry. TOLL seeks true monopolies. We believe competitor ETFs are overexposed to tech and consumer. TOLL, I believe, is a recent ETF. Valuation opportunity for stocks with competitive advantage and inflation-linked pricing. They will talk about this later, about how you can invest in businesses that have pricing power, how inflation is not a problem for them. TOLL is managed by a seasoned global investor employing consistent investment process. Tema is an active ETF manager supported by partners. Fair enough. Why the TOLL ETF? And this is very important. This is a very important slide about their strategy, and I believe also my strategy and a lot of my clients' strategy too. Why TOLL ETF? Companies defined by barriers to entry. You have thousands of stocks in the stock market, thousands of public companies, and you have to decide who will be the lucky winners that will participate in your growth. Well, maybe you want to only invest in businesses with barriers to entry. This is what I like to invest in. So what are the barriers to entry for public markets? You can have economies of scale. Scale leads to lower cost and competition. For example, semi-manufacturing, paint, ASML, or Sherwin-Williams. Maybe what I would like to do is to check the Guru Focus pages. Could be a good one. You all know ASML, so the EUV company, they have a moat. They are in a monopoly worldwide. You have to go through ASML. And if you look at their economies of scale, their competitive advantage is absolutely huge. And look at the results. Revenue is literally up and to the right. Net income up and to the right. You have a buyback machine, net cash, that is creating long-term wealth for their shareholders. The other one is Sherwin-Williams. That actually I want to go deeper on this one. I believe they have a great moat. They sell paint for professionals, but also normal people. Okay, very high margins. And if you look at the revenue growth, up and to the right, net income growth, up and to the right, free cash flow growth, completely decent, and they are doing buybacks. Now the valuation for Sherwin-Williams is forward PE ratio of 26. Starts to become reasonable in my opinion. So you have two quality businesses with a moat. Let me continue. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. You have other moats that can create huge advantages in the long term. The strong network effects. Every additional user increases the value of service exponentially. So you have the exchanges, stock exchanges, obviously, the payments. You can have the social media companies like Meta platforms, Google, etc. Every user adds credibility, adds efficiency to the business. And because the business is more efficient, it reaches more people. So you have this virtuous cycle, this beautiful flywheel that is working for strong network effects. I want to go through these barriers to entry because as I'm talking about specific stocks here, maybe it's a good opportunity for you to look at your portfolio at the same time and ask yourself, do my companies have a moat? What is their moat? What is their barrier to entry? I can go through Visa if you want a little bit, so you can see how powerful this business model is, but let me be real quick. You have revenue literally up and to the right, net income up and to the right, free cash flow up and to the right, buyback machine, sky high margins. They are literally generating free cash flow every year, and the growth is superb. Non-replicable physical assets. This is a little bit of a tricky moat, things that can't be replaced. You have railroad companies, for example, that are a great fit like this. The infrastructure is so big that you can't replace them. This is part of a moat. The cost to recreate this business is huge. Next one is regulation. You have regulation sometimes that creates natural monopolies, like the pharma industry, Novo Nordisk, Eli Lilly, the medical technology, Thermo Fisher. You also have companies that are helped by the government, meaning it's known to everybody that there is one leading company here and the regulation is helping this. Fair Isaac is a good example. You all know the FICO scores in the US and the government lets them do whatever they want basically. Okay, so you have a few companies in this regulatory regime. You have another one called Otis. It's a elevator company. And you need to buy an elevator for a building, and you need maintenance. You need somebody to come and check your elevator every year. So you need a maintenance cost every year. So Otis will make money every year. And once you have your installed base, well, you have this infinite maintenance cost. And the government is forcing people to check on their elevators every year. So literally the government is helping these elevator companies. And the last one they mention are high switching costs. It costs time, money, productivity to switch to a competitor. I love this moat actually. So you have the data providers. S&P Global is a good example. You have the index businesses, which S&P Global is part of. You have MSCI, that I'm a shareholder of. MSCI is known for their benchmarks, their index segment. If you are a fund manager and you've been comparing your performance, benchmarking your performance versus the MSCI world, for example, and you have created your track record, your reputation for the past decade of benchmarking yourself with the MSCI, what is the cost of changing your benchmark? It will destroy your reputation. So even if for some reason sometimes, even though the MSCI index provider, if they double their price to allow fund managers to benchmark themselves against the MSCI, if their price is double, fund managers are kind of forced to continue paying MSCI to not break their winning streak. Like on Duolingo, you want your winning streak and you want your reputation to be built to compare yourself with the same benchmark every year. It goes up and down. What if you change your benchmark? Boom, your whole reputation. It will make people ask so many questions. Why do you change your benchmark? Do you adjust for data? Maybe you adjust for something that is cheaper. You compare yourself to a lower benchmark. It's very bad. Same thing for people who compare themselves to the S&P 500, like myself. This is why on my website, you can see my coaching program for the first link in the description. I have my website and I have my performance. And I compare myself with the S&P 500 because the goal is to outperform the S&P 500. So maybe that's the hardest index to beat. but I like the challenge so far, and I'm winning so far. So let's touch some wood so that it continues. Nothing is certain in this world. So yeah. This you have the high switching cost, aircraft parts, GE Aerospace, Safran, you name it. Safran, it's a French company, by the way. Very proud of having a quality company as in our French territory. If you look at the financials, that's a little bit of a mess. You have different segments inside Safran that are very promising, very high margins. Same thing for GE Aerospace. That is, they do the same thing actually. So don't look at the track record for this one. Look at the past years, because it was a spin-off. It was a little bit of a technical story. I won't go deeper on this video. That's not the topic. But just so you know, you have some businesses that have huge switching costs. Another industry that has switching costs are nuclear reactors. If you are a company that has been working on the maintenance and the security for operating a nuclear facility, what will be the cost for the nuclear facility to change providers between you and the other one? You have created trust, reliability, you know everything about the nuclear facility, you know everything, and they know you. You can increase your prices. The cost of switching is huge. What, they will change to a new guy that has no experience, that has never worked with them before, just because it's a little bit cheaper? I don't think so. When you work with nuclear reactors, you want safety, safety, safety. Another one, I can give you plenty of examples because I've been working for this for more than 10 years, so normally I should know my stuff. Simpson Manufacturing, they sell wooden connectors for a strong foundation when you build a house, and they've been creating this huge trustworthiness with their clients of being the safest option when it comes to wooden connectors. What is the cost of changing Simpson Manufacturing connectors to a cheaper Chinese opportunity, to a Chinese company that will sell at half the price, but you're not sure of the quality? When you build houses, you want safety, 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 safety. So people continue to go to this company, to Simpson Manufacturing. Another example, I can give you plenty of examples, but we can move on. Another example is a Fortinet or any cybersecurity provider. It's a pain in the neck to change your cybersecurity provider. They have access to all your data. Your staff is already trained to operate with this cybersecurity provider. If you change your provider to go to a cheaper alternative, you will maybe have a leakage of data. You will have to retrain your staff again for another software. It's a mess. People are lazy and they just don't want to switch, and they will take the price increases as much as they can. This is why I invest in quality company. You have a moat when you deserve it, and customers will stay with you. TOLL focuses on durable, tangible, dominant moats, creating a better core. So you have a few things here. You have 3 criteria: dominance, tangibility, and durability. And you have a few differentiations between the classic moat investing and the deep moat. The goal is to differentiate between the no moat businesses, narrow moat businesses, and wide moat businesses. And the second step is to only invest in wide moat businesses. So when you have deep moat, you are in a monopolistic industries. I need to drink a little bit of water. You have less competition. You are basically the king of your industry, and nobody will replace you. And when you compare this to other companies, when they don't have such a wide moat, you will lose your dominance. You will lose your pricing power, and it will be much more competitive when you will have a Chinese competitor. Second difference for tangibility. For deep moats, moats are tangible and defined. You have physical assets, toll gates, for example, or railroads. You literally can't replace this. And for other businesses, it's about intangible value. It's about brand equity, low quality moats, in my opinion. It's very hard to replace tangible moats. And the third point is durability. Focus on depth first, dominant deepening moats compared to things that are focused on width first. Okay, so 3 important criteria to judge whether the moat is wide or not. And now you have an example. Some of the strongest businesses operate in monopolistic and oligopolistic structures. You have Canadian Pacific, operates in a Canadian rail duopoly. This is the number of Class 1 large railroads in North America. Over the past 100 years, we went from 200 railroad companies to now 6. Yes, so it will be very hard to replace Canadian Pacific. The number of players have drastically been reduced. The same thing is happening for the semiconductor industry, by the way, if you want to cross-read things. And the next company here on the list that can't be replaced is Visa. You have Visa and Mastercard. That's 80% market share. They own everything. You have to go through them. They are literally taking a take rate on every transaction that is happening in this world. That's their moat. You have to go through them. You have a revenue growth that is sustainable, 10-15% revenue growth per year, free cash flow margin that is sky high and staying sky high. You have earnings per share growth at 15% per year and a ROAC, return on invested capital, of 30% per year. Talk about a wide moat business that will be completely stress-free for you. Full disclosure, I don't own Visa, but I own Mastercard for similar reasons. We are talking about a leader, sky-high margins. Margins are staying sky-high. And if you look at the revenue, definition of up and to the right. Net income, definition of up and to the right. Free cash flow, up and to the right. It causes me zero stress, zero anxiety, and I don't have to waste my precious time focusing and monitoring on Mastercard. If there is a drawdown in this market, if there is a crash, I know that Mastercard will be safe and will go down less than the market. If there is upside, if there is inflation in this world, well, this is a royalty company, so Mastercard will benefit. The risk reward for investing in Visa and Mastercard, I believe right now is great. You are talking about a company. They don't try to make stupid acquisitions. They love buybacks every year. They don't have a debt problem. They are paying a small dividend. They are growing earnings per share 15% per year. A stress-free life. So I have a pretty big position in Mastercard. Every quality investor at the end of the day, sometimes they have to own Mastercard. It's one of the ultimate quality companies. It will not get you 30% per year, but it's a defensive play for my portfolio. Okay, let me continue. Monopolistic businesses have the potential to earn attractive returns on capital above the market. Obviously, if you have a moat, you can have better prices. You have a lot more efficiency. So the ROAC, the return on invested capital, is better. If you look at the cash flow return on investment, you compare the white moat portfolio that they have to the S&P 500, to the MSCI World, to US Treasuries, you are way better. Okay, consistent value creation tends to be an investor's ally. Obviously, if you only invest in monopolies that can have price gouging for 10 years in a row, obviously you will have better margins, you will have better growth, obviously. And you want to be invested in this kind of businesses. I mean, there is no shame in investing in Mastercard and Visa at all. There is no shame in investing in ASML. And a few months ago, ASML was down massively and people hated on this company, saying China will eat them up. Now the sentiment has shifted because the stock is up and now they say ASML is the king. Yeah, sentiment will always change in the short term like this. Price drives narrative. There is no shame in investing in a monopoly. You can make a lot of money in the stock market. The goal, this is what I teach my students too. The goal is not to be a church. You are here to invest your wealth, to build long-term wealth for your future children or for yourself, to buy a new house, to buy a new yacht. You can do whatever you want with your capital. You have to invest your dry powder to compound and beat the market. You are not here to judge the world. You don't have to invest in the world you wish to see. You have to invest in the world you have right now. You are not a church. You are not a foundation. You can have some ESG boundaries, meaning some people don't want to be invested in cigarette companies or weapons companies, but you are not here to change the world. You are here to beat the market. This is why you are watching this video and watching this channel, by the way. If you are not subscribed, feel free to subscribe to this channel. The goal is to beat the market. So you want this outperformance. You want to be invested in clear leaders. You want to be invested in companies that will reward their shareholders. Good businesses tend to remain good. Oh, this is a great point. Poor businesses tend to remain poor. Here is the return on equity. Even though this metric would work for any metric, return on assets, return on invested capital, return on capital employed, anything you want, or margins. On average, for the past 50 years, 60 years, you can go further in time if you want. In red, you have past high profits. These are the return on equity ratios for low quality businesses in green and high quality businesses in red. What you see is these two lines never cross. There is not one moment in time where suddenly a poor business becomes a great business. Or maybe you have one out of 50,000 stocks, so it won't move the needle. On average, a superior business will stay superior because of the economic reasons we just talked about. If they have switching costs, if they can't be replaced, if they are in a monopolistic position, on average, good businesses will stay good. This is also a key reason why I only invest in winning companies. Sometimes you have the winning company, they are at the top. The second best company in the area is much lower in terms of return on equity margins. And the third one is much lower, okay? So sometimes the third best idea is cheap. And you may be tempted to say, oh, it's cheap compared to the industry, so you will have a reversion to the mean. No. The best one is sky high. Look at Hermes, for example, my French luxury company. Sky high, top of the top, best of the best. You don't have clear competition. All the other guys, like the Kerings of the world, they just fail. They don't have the same margins as Hermes because Hermes is the best in the world. That's it. I'm biased because I'm French, but if you look at the margins, it's true. Let me continue. Why now? Quality equities perform the best in years after peak rates. If you look, this is a very smart slide. They have done the work. Equity performance in years after peak rates. So rates meaning interest rates. Yes, interest rates. Now we are in an inflationary world, but the interest rates are going down. What performs best when the interest rates go down? They have created this study, and we've seen that quality in green has the best performance after 1 year, 2 years, 3 years in this environment. Question for you. If you want to outperform the market, do you want to focus on quality companies now that we just started this new cycle? The answer is yes. Tech and consumer are not true monopolies. Since 2015, $1 trillion invested in tech venture globally, 600,000 new US tech firms created, Generation Z changing consumption trends, renaissance of new internet-enabled direct-to-customer brand. Direct-to-customer brand. It's very hard to operate in a tech environment. Trends are shifting. We even see this for brands like Nike. In the past, you had the Michael Jordans of the world. You had key athletes that were linked to Nike. Okay, if they succeed, Nike succeeds. Now you will see that the athletes are not so much collaborating with one brand. Sometimes they have some partnerships, but their Instagram profiles are their brands. They can be much more agile, much more flexible. You are not linked your whole life to Nike. You see younger athletes right now that are more free when it comes to their partnerships. So brands, tastes are changing very fast. Seasoned global equity investor, so you can see on the internet what Yuri has to say. You have great videos, great interviews about this fund manager. I believe he will do great things in the future. If you need to invest in a quality ETF, maybe that's a good one. Do the due diligence, but for the moment, I love what I see from Yuri. So congratulations. You have a lot of experience in this field, and I believe he will do great things. Okay, why Tema? Process, bottom research, product, high quality, and firm. Yeah, okay, so this is the pitch for their fund. You want top-down idea generation, bottom-up. Very well, they talk about their process, and we talk about this. Oh, this is important. Basically, this is the same way I work, is to find ideas. You start from the low base, 50,000 companies, stocks in the world. And then you decrease. You only want to be invested in high margin businesses. Boom. You only want to be invested in companies that are growing. Boom. And you reduce your investable universe. You want to be invested in companies that like their shareholders. Boom. You only want to be invested in companies with a reasonable or cheap valuation. Boom. And at the end, you found a concentrated portfolio of high quality stocks, of winning companies, of competent management teams that understand capital allocation decisions, and you can buy them at a cheap price. This is the formula to outperform the market. Let me scroll down. Security analysis, you focus on good businesses, you focus on balance sheet, you focus on valuation, cash flows, and the edge. This is their circle of competence. Portfolio construction, okay, fair enough. Now what I want to do is to show you their portfolio, so you don't have to do the work. You can literally only analyze companies that they invest in. And I know sometimes on YouTube you are lazy, so we'll do this together. Put me at 2 times speed if you want, if you think I'm too slow. Risk factor, antitrust is the reason. Yeah, they highlight a couple of risks. Antitrust is a good one, especially for Fair Isaac right now. FICO, you have some clear risks when it comes to the government. And they talk about their portfolio allocation, blah, blah, blah. Okay. Safran, Airbus. Not all competitive advantage is created equal. This is a great slide. Less competitive, more competitive. What is competitive? Hotels, restaurants, airlines. People don't care at all about your airline's moat. At all. I'm not talking about luxury airlines like Emirates, for example, or Singapore Airlines. But for basic hotels, basic plane tickets, people want cheap, people want efficient. At a good date, at a good time, we don't care about the name. It can be Lufthansa, it can be Air France, it can be anything, Delta Airlines, it can be anything, you just don't care at all. And what is the best ones, in their opinion, that is the less competitive and the more durable returns? That's payments. Okay? The case study is Moody's here. That's the end of their slide. So we will maybe end this and look at the portfolio later. Moody's, the credit rating leader, essential credit market infrastructure, duopoly with the S&P, and they've been a duopoly for years. And funnily enough, they were the cause of the subprime crash in 2008. Part of the problem, right? Because they were literally lying, and they had a lawsuit in 2014. They had to pay $1 billion in fees. Anyway, they were in the eye of the storm, and they still survived, and they are still thriving. This is a clear sign of a moat. Literally, this company caused a crash that hurt the world, the entire financial system. It was a bad company that was lying to the world, and still they survived. Their margins improved. They continued to grow, and they are now in a leading position, still a duopoly. It's a moat, and the government don't have to say anything about it. They were not regulated that much, so they can continue to be a leader in the rating industry. Blue chip shareholder, false perception of cyclical revenue. Yeah, because of the mortgage market. Anyway, operational base, network effects from combining mission critical proprietary data and analytics. Balance sheet, it's a capital light business model. return 100% of free cash flow to shareholders as dividends or buybacks. Valuation, you have a price to free cash flow of 30, seems cheap versus the stable revenue growth profile. And what is the edge? They know, okay, yeah, they know their business. You have recurring revenue and index pricing. Yeah, fair enough. Aren't monopolies bad? Well, you know that they are not bad. No, not at all. So I want to go to their website now and see their portfolio. You can go here. You maybe have to download an Excel file, fact sheet. Not the fact sheet, I want the I have found it before shooting this video, so I know you exist. Download the holdings. Let me open numbers. I don't have Excel on this computer. Here we go, guys. If you want to clone this fund when it comes to quality investing, I will scroll down so you can make pause in this video, take a screenshot and continue, okay? Here we go. How many companies do you own? How many companies do they own? 44, 43. Something like this, about 40 company, and you will spot some names that I talk about on this YouTube channel, which is great. Their biggest conviction, this is here, look at this, the percentage of their portfolio, percent of NAV. It's a strange format. Sorry, I don't have Excel. I have other things, but this is it. You have 6% of their portfolio in GE Aerospace, 5.6% of their portfolio in Visa, Intuit. You have Lab Research. I'm a shareholder also of Lab Research. KLR Corp, Moody's, Intercontinental Exchange, MSCI. I'm a big shareholder of MSCI too. S&P Global, great business. Fair Isaac is here. It's a moat company. Copart, moat company. You have plenty of companies. You have Deere, you have Lowe's, you have Airbus, you have Align Technology, which is hated at the moment right now as I'm speaking. So maybe it's a good deal here. I mean, Align has become cheap. Martin Marietta here. Sherwin-Williams, so the paint company. You have Fortinet here and JP Morgan, etc. What is Fortinet on their portfolio? The only cybersecurity company they own? Let me scroll. No, not cybersecurity. No cyber, no Synopsys, it's tech. On semiconductor, Waters, no. Maria Marietta, no. Deere, no. Fortinet, Elevance, no. Vertex, Integris, I don't know this one. Church and Dwight, absolutely not. No. It seems KSAT Technology, and they have Mastercard also. Yeah, it seems like Fortinet is in their portfolio, and that's the only cybersecurity company they own. Well, we think alike. It's the cybersecurity company I like the best at the moment, and I think it has a lot of potential to outperform the market. It's one of the best companies in the world, in my opinion. So yeah, it's a small position for them. It's 1% of their portfolio. It's a bigger position for me. But anyway, I'm not a fund. I'm flexible. I'm a retail investor. So this is why I can do whatever I want with my portfolio without constraints. Anyway, you can copy this list. You can put this. You can send a screenshot to ChatGPT and tell ChatGPT that you want to investigate, do more research on this one. Do more research, do more analysis on this one. Anyway, I just wanted to make this video to show you the way because I'm doing this on my channel. Plenty of other retail investors are doing it and outperforming the market. And you have all the other professional fund managers that are showing you the way. Investing in quality companies that will make you outperform the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.